You know those huge, world-changing companies? Ever stop and think about where they actually come from? Because before the big headlines, before the IPOs, there's always a first check, a first believer. And that's the world of angel investing. So today, we're going to break down the entire playbook for 2025. Right, this is the big question. And the answer isn't some giant Wall Street bank or a massive corporation. Nope, it's a very specific kind of person, an angel. They're the ones acting as the primary fuel for innovation, writing those very first checks that turn a dream on a napkin into a real company. So let's officially define this person, the angel investor. This isn't a faceless fund. This is an individual betting their own personal money on a brand new, unproven startup. It is a huge gamble, no doubt about it, but it's the absolute lifeblood of the entire startup world. All right, here's our game plan. First, we'll cover who today's angel investor really is, then how they even find these deals. After that, we'll get into how you put a price on just an idea, how you structure the actual investment, the secret math to winning by not losing, and finally, we'll take a peek into the future.
Okay, let's dive right in. The 2025 angel investor. So who are these people writing the checks that are basically funding our future? You might be surprised by how much the profile of an angel investor has really changed.
So first things first, let's be clear. Angels are not the same thing as venture capitalists or VCs. It all comes down to one word: flexibility. See, an angel is investing their own cash. A VC, they're managing a huge pot of other people's money, which comes with a ton of rules. This means angels can move faster, they can bet on passion projects, and they can take a chance on a wild idea that a more traditional VC would just have to pass on. But hold on, it's not like just anyone can start writing checks. This is a super high-risk game. So in the US, the SEC has rules. To be an angel, you generally have to be an accredited investor, which, yeah, usually means hitting certain income or net worth levels. But check out that last row. This is really cool. It's not just about money anymore. If you have certain professional financial certifications, you're in. It's a big deal because it acknowledges that knowing what you're doing is just as valuable as having deep pockets. Okay, so let's say you qualify. Now what? Well, the name of the game is finding great companies to invest in. And in this world, that all comes down to something called deal flow, which is just the constant stream of investment opportunities that come across your desk. For most modern angels, the key here is the syndicate. And honestly, the best way to think of it is like a party bus for investing. You have one experienced investor who's the driver. They find the deal and do all the homework. Then, everyone else can hop on the bus by chipping in their capital. All that money gets pooled into one legal entity, a special purpose vehicle, or SPV. Then, that bus, the SPV, makes a single, clean investment into the startup. It's genius, really. It gives smaller investors access to the best deals, and it keeps the startup's financial records simple with just one entry, not hundreds. So once you've found a deal, you hit what is probably the hardest part of this whole process. How do you value a company that might not even have a product, let alone any revenue? This is where we get into the art and science of pricing a dream. I mean, really, this is the million-dollar question, right? All the normal ways you'd value a business are totally useless here. You can't analyze profits that don't exist. So early-stage investors have literally had to invent their own methods just to figure out where to even start. And one of the most popular ways is the scorecard method. You basically value a startup by comparing it to similar companies that got funded. But look at these weights. Look at what matters most. The tech, the product, yeah, they're important. But at 30%, the team is the single biggest piece of the pie. It's such a powerful reminder. At this early stage, you're not just investing in an idea. You're investing in the people you believe can make it real. Okay, once you've landed on a valuation, it's time to actually structure the deal. And this part involves the legal documents that define all the terms and protect both the founder and you, the investor. Now, in 2025, the vast majority of these deals use an instrument called a SAFE. It stands for Simple Agreement for Future Equity. It's different from the old-school convertible note, which was technically a loan. A SAFE is much simpler. It's just a contract that says you get equity in the future. There's no interest, no expiration date, which makes it incredibly simple and founder-friendly. And that's why it's become the undisputed industry standard. But even within that simple SAFE, angels need to negotiate a few key protections to manage their risk. A valuation cap acts like a price ceiling, making sure they get a fair deal for investing so early. Pro rata rights are crucial. They give you the option to invest more later on so your ownership stake doesn't get smaller. And a liquidation preference is kind of like insurance. It just means you get your money back first if the company sells for a low price. It's all about creating a fair balance of risk and reward. Okay, so we know how to find a deal and how to make a deal, but how do you actually make money doing this? The answer is kind of surprising. It's less about picking the one perfect winner and more about the incredible power of portfolio math. Let's just start with a sobering number. 50%. That's roughly how many of these early stage startups just go to zero. They fail completely. And understanding and accepting this reality is probably the single most important key to being a successful angel investor. So because so many companies fail, making just one or two bets is basically a recipe for disaster. This is exactly why the pros build a diversified portfolio of at least 20, maybe 30 or more companies. The goal isn't to avoid failures. That's impossible. The real goal is to stay in the game long enough to find that one or two massive successes that can pay for all the losses and still generate a huge return. Now, because this kind of investing is so risky but so vital for the economy, a lot of governments offer some powerful incentives. The UK is a fantastic example. Their SEIS scheme gives investors an incredible 50% of their investment back immediately as a tax credit. Think about that. Your investment is effectively de-risked by half from the very first day. And over in the US, the whole landscape shifted in a huge way in 2025. New legislation totally supercharged the tax benefits for startup investors. As you can see, if you hold an investment for 5 years now, 100% of your profits are federally tax-free. This whole tiered system is just a massive incentive to back innovative companies and stick with them for the long haul. So finally, let's look ahead. This world is always evolving, so what does the future hold for the earliest stage of capital? What's coming next? Well, we're seeing 4 key trends really shaping things. First, AI is being used to help source deals, analyzing founders and pitch decks to find hidden gems. We're also seeing the rise of solo GPs. These are experienced individuals running their own agile micro-syndicates. There's also a growing focus on ESG and impact, so investing in things like climate tech. And finally, a lot more specialization, with groups focusing only on deep tech niches like AI safety or bioautomation. And when you put all of this together, it points to a fundamental shift. Angel investing in 2025 isn't just a hobby for the wealthy anymore. It's a serious professional discipline. Success today demands that you master portfolio math, understand complex tax laws, and build a strong personal brand that the best founders actually want to partner with. And that leaves us with one final thought. As data and AI bring more and more science to investing, what happens to the art? Will that flash of insight, that simple gut feeling about a founder, still have a place in discovering the next truly world-changing company? That's the question the entire industry is grappling with right now.